Hello and welcome to a brand new episode of Smart Money. Now this week we kickstart a new series on the outstanding women in finance. We profile all those women across the financial spectrum who have made a name for themselves and of course who've had a bright career. Our guest on the show today is a lady who has completed 3 decades in the mutual fund industry. She runs one of the oldest mutual funds in India. Swati Kulkarni of UTI Mutual Fund is joining us here on the show. Swati, it's a pleasure having you on the show. Thank you so much for being with us. You know, first I wanted to congratulate you on completing 30 years in this business. I'm sure it's not been easy. You have been managing one of the oldest mutual funds in India. How has the journey been for you so far?
Yeah, thanks Sonia for inviting me here and naming it as a most outstanding outstanding women in finance, being the first in this series. So really privileged to have this honor. Yeah, the journey actually it began as a very humble beginning, I would say, and journey of course has been rewarding because if you see, I got an opportunity somewhere down the line in 2004 to independently manage the funds and been able to contribute in some way to the wealth creation journey. And of course, getting master share to manage in 2006 was a special, I would say, a page can be written on this because typically, this was the fund which my father had initially invested some sum for me, and I had seen this fund's NAV growing, and that kind of ignited some interest from my side to look at mutual fund as a career. And as the luck could have it, in 2004 I got to manage this fund myself. So yeah, that's the part of my journey here at UTI.
Wow, that's a fabulous story to share, right? I mean, your father investing for you in a fund and then eventually you going and running that same fund for over 15 years. But what are the lessons from your investment journey, if I can ask you that? The best and the worst moments. And I'm asking you because, it's become increasingly tough to survive in this world because of so much disruption. Sectors are in and out of fashion every 2 years. So in an industry where you've survived for 30 years, what has been the best and the worst part of your journey?
Yeah, so I would say actually, see, one good part of our the whole journey is that in UTI we always had emphasis on the in-house research, and also there have been learnings. It's a learning curve for everyone. It's not that you come with of course the qualifications are there, but you learn with the experience, and therefore I would say that the times when interest rates started to move down from 19% to 12%, and also how the debt could probably destabilize the businesses. So there has been learning across the curve, I would say. As far as the best moments are concerned, like in 2004, when I got this opportunity, when Mr. Damodaran was our chairman, and he he showed a lot of faith in my capabilities at that point of time. So my best moment, I would say, came when in 2010 I could receive an award at his hand, being a mentor. It was really a best moment for me, I would say. And as experts have said that this time shall also pass, I would say that the worst moment was again, I would say, a learning. And this was the time which was in 2009, if you remember, in May 2009, I guess, on a single day after the election results, the market went up by 18, almost about more than 19%. And that was the time, with the backdrop of global financial crisis and markets already running up from the bottom by about 40% ahead of the election, we had not deployed the cash that was there in the fund. And so I think that was the worst moment on that day when the market went up. Like I was totally, worried about how do I kind of deploy and how do you actually come back with the kind of drag that this cash position could have had. So yeah, that I think looking back, that was the worst moment, and we have learned from it. So now for last, I think I would say about 12 to 13 years, the cash levels haven't gone beyond 5% for any of the funds.
Okay, and as you said, right, this too shall pass. I mean, that's the only way to navigate through tough situations. But I know it's 2022 and there are no gender biases in today's day and age. But in your 30-year career, I'm sure you have faced some challenges on the gender front, because there's been, pay gap that we've spoken about several times in the past. It's been tough to navigate in a man's world like the finance industry. Have you noticed that things are very different now compared to what it was, say, 15, 20 years ago?
I would say actually it depends on the individual. I was fortunate to have a good support system. So this is as far as the personal side is concerned, and how you actually get that support is very important. Now I see that there are many young women in the profession. Of course, this profession demands a lot of effort. I would say you're actually on the job all the time. It's like even on the holidays, you would be actually reading something, or nowadays the information is so much that there is a feeling of missing out if you don't keep the track. So I would say that when it comes to the expectation from your investors, your stakeholders, the expectations are same. There is no gender bias as far as the expectations are concerned. But as a personal front, I think with the the family or the role of a woman in a family is still quite important, and in terms of those, perhaps at least in my case, I had to compromise on the social life, and I think that is something which might be tough for women. Balancing both work and life.
Oh, absolutely. It's a struggle every day. I understand where you come from. But let's talk a little more about your investment style, right? Because you've managed this fund for so many years, you've given consistent returns, and you've talked about how you like to find stocks and companies that have grown at a reasonable price and have a competitive franchise. So let's talk about that. How do you identify these companies?
Yeah, so actually I would say that there are different sectors different companies have different advantages. So take a case of let's say a retail bank. Now this bank, in terms of the franchise or what is important for banks is how well they protect their spreads, and the part of it comes from the low cost of funds. So we have seen that the banks concentrating on this, and if the low cost of funds remains for a very long period of time, that also means that the bank doesn't have to take undue risk to lend in a risky assets, and therefore earn that higher spread. Even by lending to quality customers, they can actually maintain those spreads. Their appraisal standards then can be far higher, and then all this results into substantially better profitability growth, increasing market share. So these are some of the things that we would typically look to differentiate the banks. And I would also suggest that that this is what I have experienced, is that often when the times are tough, the market gets into a very pessimistic view about some of these franchise, and they tend to overlook the advantages that the companies could have. One case in point is the corporate banks, which was actually having very high CASA ratios, but going through the bad NPA cycles. And this bank, depending on the high CASA ratio as well as the capital adequacy, we had seen that this bank was quoting at below 5 times pre-provisioning profit, and that was a time when a strong franchise was available at a very, very reasonable price. And one last thing when we are discussing banks, Sonia, is that typically a good franchise would probably look expensive for a very long period of time. But what is important is that if the growth runway has been steady and for a long period of time, I think that itself gives a compounding returns for the investors. So that's about banks. I could also give you some examples of B2B businesses where typically these are the businesses where the buyer is also equally strong and highly negotiating. So therefore, pricing power, which typically we look for in measuring the competitive franchise, that may not be the pricing power may not be there with these kind of companies. So there, if you see, what we look forward is that if this is a B2B, whether the companies are investing ahead of time in terms of bringing those capabilities. So take, for example, an IT sector. Now, one is, of course, that IT sector companies have some of the companies have very concentrated client concentration. So with scale, the large cap IT companies, we have seen that they not only have a very diverse clientele, so that reduces the risk of any vendor consolidation or any company client actually reducing the business. But also the margins of these companies are far superior than the mid-cap companies, maybe about 7 to 8%. So that is about, that gives them the ability to bring up the capabilities for the next kind of technology opportunities. In pharmaceuticals, we would look whether the company is investing, whether the pipeline of NDAs is good, R&D has been good, and so these are the things. Again, capex intensive businesses. If the company clearly shows the advantage as far as their capex cost, relative capex cost being much lower, that adds into better return on capital employed. So that's I would say that in a nutshell, to look for these sustainable, durable advantages that helps in finding out these companies.
Sure.
And if you happen to find such businesses, it's better to hold on for a longer time.
Okay, got that. So that's on banks and IT and your style of investing. But let's do one thing. Let's slip into a quick break. When we come back from the break, we'll continue chatting with our outstanding women in finance, more on Smart Money in just a bit. Stay tuned. Welcome back to Smart Money on CNBC-TV18. Our special series, Outstanding Women in Finance, is what we have kick-started this week. And we have Swati Kulkarni of UTI Mutual Fund, who's been in the mutual fund industry for 30 years now. So a great career. She's talking to us about her style of investing and how you should pick high growth stocks that have a competitive franchise in order to build long-term wealth in your portfolio. Swati, you were telling us before the break about a competitive franchise, about high growth, but you also look at dividend yield investing. Can you explain a little bit about that to us? Because dividend yield stocks have done very well, but for the uninformed, how do I get into it now?
Yeah, so I think when it comes to investing under dividend yield investing style, what is also important is that not just the current dividend yield, but the sustainability of those dividends and also the capital appreciation potential of the company that you are going to invest in. So if you want to have some visibility around this, what is important is that the free cash flow that the company has been generating, the free cash flow yield should be higher than the dividend yield. And also the profit growth should be there to kind of see an increasing dividend receipts even if the dividend payout ratio remains same. And our studies of the Nifty 500 companies, if you see on a last 5-year basis, we have seen that out of the 144 companies, if you apply both these filters, actually the 38 companies qualify for this, and the return increases, average return increases from 15% from this 144 companies to about 24% for the 38 companies which have both higher free cash flow yield than the dividend yield and an earnings growth of about 12% in the last 5 years. So I think that is what is very important, both free cash flow generation, sustenance of dividend, and the capital appreciation potential.
Okay, so that's on dividend yield companies. But, just giving us a bit of a bird's eye view on your investment journey, right? I'm sure there are a lot of mistakes that you have made as well in your 3-decade-long career in your own personal investments. So for the viewer who's watching you right now, if you had to identify 1 or 2 investment mistakes that you made that perhaps others should avoid or can learn from, what would they be?
Yeah, so I think one clear mistake that I remember, and that's like I have decided not to go that path, is like in 2000 I was, quite the exciting opportunity that I thought was in the media space. That was a company into special effects, animation, and there was a lot of option value that we were building much higher than the actual business that the company was running at that point of time. And so that's one thing which I would say that I would avoid forever, that giving too much of option value and having a lot of hopes around this. On a personal front, I would say, Sonia, that I as a young investor on a fund manager, I thought I could time the markets better, and I regret that I did not invest at when the markets corrected in 2000 from 6,000 levels to 2,800. What is important at 60,000 of Sensex is not at what level I invested. Even if I had invested at 6,000, that is a 10 times return. So the quantum is more important, and that is on a personal side, I would say that's a great learning. And of course, at that point of time, SIPs were not in fashion. So maybe if that was the case, I would have started to save little early, which is a part of advice nowadays we give without actually practicing it, but more from realizing it later.
Okay, that's some pearls of wisdom, right? But just one point on that mistake to avoid. You said that there are concept stocks, there are, stock trending stocks, maybe that you should avoid. So what do you do? How do you decide? Because there are some phases which pan out really well for sectors. Defense, for example, has been a theme that has worked out for a while now. But how do you differentiate between just a passing fad, a trend, and something that's long term?
So I get some of the things that, just addressing the market size opportunity, or, analyzing what is going to be the market for such businesses. And if at all the companies have a strong potential, for example, I can give you a telecom stock example. When this came up in 2005, 2006, the mobile telephony, there was a clear argument about the, under penetration. We hardly had a few percentage points. The tariffs were going down, and therefore the adoption of mobile handset was a clear case that we could build in. So I think if you could, so at that point of perhaps that the existing business wasn't that great, but there was a solid runway for growth, and the penetration levels were so low, and that is what something you can differentiate even today in the new age businesses. And you could be looking at these businesses if there are solid, the market size opportunity is quite good, and the companies have right to win there.
Okay, and finally, before we end the discussion, Swati, wanted to understand from you, there are a lot of young people who perhaps are looking to get into this industry. You were mentioning that a lot of young women have entered the mutual fund industry as well. What is your advice to the young investor watching you right now, perhaps someone who has to start their investment journey, or maybe even get into the mutual fund space as a career?
So I think first of all, it is important to realize that wealth creation is a marathon, not the sprint, and therefore it is important to avoid unnecessary trading. And I would like to also say that it is it's also important that you avoid the value destructors early enough. Secondly, I would say that allow the compounding to play out, and I would quote that recently I saw that almost about more than 85% of the wealth that Mr. Buffett had generated is after the age of 65, and he started investing when he was in teens. So allow the time to fructify the good businesses that you would have spotted, and typically high ROC cash flow generating machines, if you happen to spot them, it's better to kind of hold on to them. And again, I'll quote Charlie Munger's quote here, which I like, and my investment style has got influenced by that quote, is that buying great businesses at fair price is going to be superior than buying fair businesses at cheap price. So that is one thing. And for professional fund managers, I think it is very important that integrity is given in this business. It's a business run on the trust. Retail money is what you are managing, and always remember that your reputation is invaluable. So I think that is something which is very important. And while we construct a portfolio, I think position sizing and knowing that there can be something unknown which might hit, and preparing for that risk is also very important when you are building your portfolio. Don't assume that the past risks are going to be a good future guide. Market and the environment always has some risk which would be totally unexpected, and it could turn out to be a nasty surprise. So I would say these things would sum up, and you would do good if you kind of take some lessons from my learnings, Sonia.
All right. What stays with me is you saying that wealth creation is a marathon and not a sprint, right? You need to give it time. Swati, pleasure speaking to you. Thanks a lot for joining us in our Outstanding Women series, and hope you continue to do the good work for many, many more decades and continue to bring returns to your shareholders and create wealth for them. Thanks a lot for joining us on Smart Money.
Thank you, Sonia. My pleasure.
Okay, with that, it's a wrap on this special edition. This is a series that we've kickstarted, Outstanding Women in Finance. So if you know any outstanding women in the world of finance, be it mutual funds, brokers, entrepreneurs, just write into us and we would love to feature them on the show. Thanks a lot for watching.